Greetings from our team at Robare and Jones Wealth Management. This is Jack Jones, the managing partner, with our November monthly market update. Before we begin, I want to thank our clients for the trust and confidence that you place in us. The very best part of our day is time spent directly serving you. So we'll get started. We first of all want to wish our clients and their families a very happy Thanksgiving. And we hope to see many of you at our curbside event, Tamales and Treats, on Saturday, December the 7th from 10 to 12 p.m. So most recently, NVIDIA, the world's largest publicly traded company, posted earnings that were a beat on both the top and bottom line. Most recent inflation data came in at 2.6, which is about a match of kind of what was expected. Core was at 3.3. So inflation, while it's not going away, is lowering. And again, the most recent inflation read at 2.6 was about what the markets were expecting. Employment has softened quite a bit. In October, we saw only 12,000 jobs added, and really that was only because of 40,000 government jobs. Private payrolls dropped by 28,000. So a really bad miss in October as it relates to jobs. We'll see if that's a trend or a one-off. Most recently in September and August, September 254,000 increase was actually reduced to only 223. August took the estimate down to 78,000. August would have been the worst in 4 years, if not for the October payroll. So we are seeing some signs of softening in the jobs market. And that kind of comes on the heels of a March to March timeframe of an 800,000 overcounting of jobs. So some weakness to pay attention to. One of the Fed's dual mandates is full employment. So that's something to keep an eye on going forward. The Fed, after 4 years of from their last cut, is cut again in September. So the Fed cut 50 basis points in September. Most recently, 2 days after the election, cut another 25 basis points. Now, there was some cautionary tone to Fed Powell's recent remarks in that he said there's no hurry to cut interest rates. But interest rates have started a cutting cycle, which is generally supportive. We'll talk about that next, of risk assets. In fact, if we go through a process where the Fed's cutting rates and you don't get a recession over a 12-month period, again, that's very supportive of both stocks and bonds. In a scenario where you get a cut and a recession within 12 months, not as supportive of stocks, down on average 3, but still supportive of bonds. So one of the key things, and we talk about this a lot, which is, do we get the long anticipated recession, or does the economy wind up in a soft landing, no recession environment? Most recent GDP growth, a little bit lighter than expected at 2.8. So again, some softening, but still positive growth. We're also entering a period of time that's typically supportive of stocks. If we go through this November 1 through tax day, you'll see going over the last roughly 100 years. Generally, this time frame, again, from November 1 to tax day, tends to be a good cyclically for stocks overall. We still see a scenario where, including NVIDIA, which we mentioned at the beginning, you still see the S&P dominated. This is through the end of Q3, where almost half of the S&P return is these 7 stocks. So we still see that concentration, although you are seeing a broadening out of beating the index. More than 60% of the S&P components beat the index in Q3, compared to only 25% the first half of 2024. So again, you're still seeing a pretty dominant top of the S&P 500 with mega cap US tech, but some broadening out in Q3 of this year. Debt levels remain a problem, 36 trillion in debt, over $1 trillion just in debt service. That continues to be something that is a risk. What we never know is what what is going to cause the markets to respond in a negative way to this risk. Interest rates going up, even though the Fed's cutting, is one indication of risk. But you also see markets near all-time highs. At the same time, debt is near all-time highs. So that's something to keep an eye on. Again, this is where deficit projections are going out for the next 30 years. Not a good line, especially when you start with a baseline of we're 36 trillion in debt, and what we're spending is about 120% of what we're taking in. So the elections have passed. So maybe this question isn't as relevant anymore. I think as it relates to the election outcomes, from a market standpoint, they were decisive, and it's over. So markets can now factor in things like NVIDIA earnings as opposed to an elevated election risk. And there's some indication that there was some pent-up spending. For example, 2/3 of CEOs saying they were delaying key investments until after the election. And now we have kind of what we know both in the White House and Senate, kind of where we are. You can look at some kind of past data to see how in that scenario markets perform. So on a growth basis, Republicans are in all three 10% of the time, and on average GDP is just under 3, which is basically where we are today. And as it relates to the S&P 500, again, Republicans 10% of the time, on average 13%. So generally, this would be supportive not only of economy, but of the S&P 500. So as we look at where we are in terms of years across the election cycle, we're now or we will soon be in the non-election year next year, 2025. On average, those years going back 100 years, on average, are up 15%. So overall, that's supportive going forward. Now, there's still a list of pessimistic and optimistic things that we'll kind of close with in summary. A reason for pessimism is we have a weakening consumer. We have debt service of the consumer that's gone up. We have a slowing jobs picture. And so all of that could lead to a recession. Again, a very weak number in October. So the consumer weakens, bringing on a recession. The Fed cuts interest rates, but less than the market is expecting. Again, recent comments saying no hurry. If the Fed does stop cutting rates or we get an inflation print that's a little bit scary, you could see the Fed backing off of cutting rates. Geopolitical risk is with us. We've got 2 major wars, both in Europe and the Middle East. Debt levels remain a concern. Earnings so far have been pretty supportive, but that could always soften. The election November 5th, we had this in the pessimistic column, but we'll put that on the optimistic column. Really not as much based on outcome, but based on the fact that the election is over and it's not contested. Markets can again start to think about fundamentals as opposed to an elevated election risk. On the optimistic side, if we do continue to get a delay, a soft landing in the economy, no recession, again, in scenarios where the Fed's cutting and no recession, that's supportive of both stocks and bonds. Inflation continues to be lower. The Fed does continue to cut rates that they started in September. We get a widening of market performance. Earnings are supportive. And again, this is more on the optimistic side now that the election is over. It's not contested. So there's not an elevated risk as it relates to that. And now that we do have the election over, and that gives us some indication of what parts of the market are going to be favored 2025 and going forward. We will be rebalancing in the next few weeks. So expect trade notes in the next couple of weeks, explaining our thoughts as it relates to rebalancing. So with that in mind, we'll encourage you to contact us to ask us any questions about how any of these things apply to you specifically. With that in mind, we will close. Again, thank you for the trust and confidence that you place in us. We hope you have a very blessed Thanksgiving. We hope to see many of you at our Tamales and Treats curbside event on Saturday, December the 7th. Until we see you again, be well and take care.